With Sinema agreeing in principle, should I be buying clean energy and electric cars or companies?
Yeah, we did. So last week, clean energies jumped on the news that there was some possible agreement on this, Inflation Reduction Bill, and uh, but it was for a variety of reasons. I wasn't positive that this thing was going to pass, and still we're not. Right? I mean, it is nice that the two senators on the Democratic side that normally, are the hardest ones to get through, both seems to have agreed that this is going to happen, and so that helps and maybe gives some more confidence towards that area. But the main reason that we bought our clean energy ETF was because it has been, on a relative basis, making more than the overall stock market since the invasion of Ukraine on the 24th of February, which makes sense. And that trend isn't going to change. So Europe is trying to get off of Russian oil, natural gas, and coal. One of the solutions will be clean energy, wind, solar, and whatnot. And so these companies are in front of the possibility of some money because it's not just going to be the U.S. that's looking to put money like they are here with this bill into clean energy. It is Europe. China's already working on it. Everybody's looking at this, in my opinion, and going to start to think, man, we need to get to a spot where we have our own energy that we control and that we're not getting from some other country who could all of a sudden become, a country we don't want to deal with. So, yeah, I think clean energy is a good bet here. The problem is that they're still fairly overpriced. When you dig into these ETFs or you dig into these individual holdings, a lot of times they're still pretty expensive versus earnings. So in this market environment, it's a little bit of an aggressive move to be in those, high PE ratio stocks. But I do like the relative strength that they've been showing recently.
What about electric cars and those companies? Because electric cars are a little bit harder to invest because there's not a lot of pure plays. I would say like you can think about Ford. Ford also has their gas and then electric, or most of those major kind of car manufacturers have mixed.
Yeah, yeah. General Motors has a fairly big presence in electric, but obviously has an awful lot in non-electric cars. And so, how do you play those? Generally speaking, when you see a electric vehicle ETF, they'll have a lot more exposure to the universe of different pieces, the battery makers
Hmm.
and the companies that are making the little inverters that make solar cells. Better is a big one that fits in those regular clean energy ones. And so the plug power things, we got to plug these cars in somewhere at the Target and New Mexico or whatever it is where we're traveling. So that type of thing is the more pure play. It's tough, and those will be included in those electric vehicle
Hmm.
ETFs, and that's how they do it. Because otherwise, you'd have what Tesla, basically. There aren't, there are a couple of other pure plays, internationally and whatnot too. But there, Rivian, I suppose, is
Hmm.
another one, right? And so it's a really limited list. You'd have a very small ETF, and the way that they do that is just spread it into the ecosystem of that whole arena, all of the different pieces. And I actually like spreading it even farther. We call it clean energy. Put the car stuff in there and the wind stuff and the solar stuff. I like that more diversified clean energy piece. Once you start really narrowing it down, if you watch those, they can get a lot more volatile. The pure solar, ETFs have been, they're fantastic sometimes, and then they're really, really can be aggressively to the downside when things aren't going right. So again, a lot of these things are overpriced on a relative basis. Tesla would be in that category. It's selling at a pretty high multiple times its cash flow, et cetera. So
Yeah, talking about those solar ETFs, like earlier this week, I forgot the name. Was it Solar Edge? Basically had a pretty abysmal earnings report, and the market didn't take kindly, and they dropped like 15 to 16%, and the all the solar ETFs got hammered.
yeah, and that Solar Edge actually was selling at 78 times earnings. The average market right now is around 18, I think. So that's very expensive. And so if you miss your earnings, I mean, people are paying that extra premium for a company like that because they're growing so fast. and all of a sudden you realize they're not, you're going to take a big hit to the stock price. And so that's where the risk stands. At certain markets, nobody cares about the PE. 2020 is a good example.
Mm-hmm.
It didn't matter. I mean, companies didn't even need earnings. They were selling at 300 times their revenue. I mean, just crazy stuff. Same thing we had in 2000, right? But this market's much more reasonable, much more focused on cash flows, which is not an unusual scenario when the market is down. People are being less risk, taking less risk as far as that goes. So that'd be my only real big caution about over investing in this category. It's just they are still fairly expensive.